Oil is trading near wartime highs. The Federal Reserve is divided, and AI megacaps are about to move hundreds of billions in market value, all at the same time. Welcome to vTalkInsight, Allocator's Lens Daily for April 30th, 2026, where we connect these cross-asset stories into one coherent picture for portfolios. In equities, the central question is whether the AI and cloud earnings engine can keep overpowering higher energy costs and tighter policy expectations. Upcoming results from the largest technology platforms, representing well over $10 trillion in market capitalization, are poised to dominate index direction. Cloud businesses at Amazon, Microsoft, and Google are showing renewed acceleration, with demand for AI services driving faster growth in their infrastructure arms. Alphabet's cloud unit has already surprised on the upside with growth north of 60%, helped by in-house chips and rising enterprise AI adoption, while expectations for Amazon Web Services point to revenue gains in the high 20s to low 30s. Across the group, capital spending tied to AI and data centers is expected to jump roughly 70% year-on-year to around $650 billion, underscoring the scale of this investment cycle. At the same time, AI specialists such as Anthropic and OpenAI are now on a combined revenue run rate near $50 billion from virtually zero 2 years ago, suggesting that monetization is catching up to infrastructure outlays. Even so, there are clear signs of strain around this leadership. Semiconductor valuations have improved because earnings growth has outpaced share price gains. But for the broader S&P 500, current pricing implies a very ambitious 5-year earnings growth path of roughly 12% per year, leaving little margin for disappointment. Market breadth remains narrow, with the equal weight S&P index locked in its longest losing streak of the year, even as headline indices are supported by a handful of tech and semiconductor names. Flows from pensions and systematic strategies into some of these winners have left positioning looking stretched, increasing the risk that an earnings miss or cautious guidance could trigger an outsized reaction. Options markets are reinforcing that message, with implied swings of $700 to $800 billion in combined market capitalization around tonight's megacap reports, even while index volatility, as measured by the VIX, sits in the high teens rather than crisis territory. That mix of elevated single-name risk and contained index vol points to a market that is sanguine on the macro backdrop, but highly sensitive to stock-specific news. Outside technology, the picture is more balanced but still generally supportive of risk. Consumer-facing names such as Starbucks, Visa, and American Express are reporting solid volumes and transaction growth, indicating that despite discomfort about high gasoline prices, day-to-day spending on dining and travel is holding up. However, the energy shock and Middle East tensions are producing visible losers, especially in travel and airlines. Booking Holdings has trimmed its outlook, citing weaker demand tied to regional conflict, while Spirit Airlines is facing acute financial stress as fuel costs, operational issues, and a failed merger collide, highlighting that the macro backdrop is generating sizable sector dispersion even as headline indices remain resilient. Turning to rates, the dominant theme is a Federal Reserve that is firmly in wait-and-see mode, but with a clear tilt toward higher for longer. Policy rates were left unchanged, and officials described the current stance as appropriate. Yet they are signaling a high bar both for renewed hikes and for any shift toward an easing bias. Core inflation running around 3.2% and moving in the wrong direction recently is central to that stance. Headline readings are increasingly driven by energy, and there are early signs of pass-through into core components such as airfares, which complicates any case for near-term cuts. The latest decision saw 4 dissents, the largest number in more than 3 decades, underlining a material split over the path ahead. Some policymakers favor reducing reliance on tools like the dot plot to keep flexibility, while others are wary of sending any signal that markets could misread as a green light for easing. Overlaying this is an unusual degree of political and legal pressure on the Fed, raising questions about central bank independence, just as Chair Powell is expected to preside over his final meeting. Rate markets have largely stripped out expectations of cuts this year, and in some cases well beyond, but they are still vulnerable to any shift in tone that suggests hikes and cuts are now viewed as equally plausible. Against that backdrop, the front end of the Treasury curve offers positive carry and looks relatively well anchored versus the policy rate, even as longer-dated bonds have lost some of their traditional safe haven properties. Investors are increasingly focused on how quickly today's energy-driven inflation pulse either feeds through into broader prices or triggers a demand slowdown that would eventually justify a different policy stance. In credit, the immediate story is the attractiveness of short-duration spread products alongside emerging signs of stress in specific pockets. Shorter-dated corporate credit is now offering spreads of more than 100 basis points over treasuries, with all-in yields above 5%. Which compares increasingly favorably with money market instruments as yield curve inversion fades. At the same time, bond markets are no longer behaving as reliable shock absorbers for multi-asset portfolios. Equity bond correlations have shifted, and many allocators are keeping duration tight and diversifying their sources of income beyond traditional high-grade benchmarks. Rapid growth in private credit has intensified competition, forcing capital providers to accept either thinner spreads or higher risk structures, which raises the premium on careful asset selection. Within that universe, there is growing scrutiny of AI infrastructure and software-related borrowers that are burning cash and taking on leverage to fund data center build-outs, without yet demonstrating durable cash flows to match. Listed financials add another layer to the picture. European banks, such as UBS, Lloyds and Santander have beaten profit expectations, with UBS in particular delivering more than $3 billion of quarterly earnings and stronger investment banking revenue. Yet elements like potential Swiss rules requiring 100% capital against foreign subsidiaries, rising loan loss provisions at peers such as Deutsche Bank, and ongoing regulatory uncertainty are tempering equity reactions and reminding credit investors that macro and policy risks remain in the system. Sector-specific stress is most visible where higher fuel costs and slowing demand intersect. Spirit Airlines' acute financial difficulties and a sharp reversal in names like Avis after speculative squeezes fade show how quickly rising funding costs and energy prices can pressure leverage balance sheets, even while broad credit indices still appear benign. In foreign exchange, a firm dollar coexists with surprisingly resilient emerging market fundamentals. Stronger than expected U.S. data on durable goods, housing, and imports, combined with higher policy rates, continue to support the dollar, yet many emerging economies are still described as fundamentally sound, with much of the damage from past oil and currency shocks already reflected in prices. Reserve management behavior is an important subplot here. The People's Bank of China and Chinese investors have been adding to gold holdings even as Western investors pared back exposure, and a range of emerging market central banks are expected to keep diversifying into bullion as a hedge against sanctions and geopolitical fragmentation. That gradual shift does not displace the dollar's role overnight, but it does suggest that, over time, more of global reserves may sit in gold and other alternatives, which could limit the scope for pronounced dollar weakness in future easing cycles while reinforcing a structural bid for the metal. For allocators, the interaction between a strong dollar, higher U.S. yields, and this slow-moving reserve diversification remains a key variable for emerging market currency performance. Commodities remain the macro hinge, with oil and gold at the center. The United States is maintaining a naval blockade around Iranian ports and the Strait of Hormuz, backed by logistics that allow carrier groups to stay on station for weeks or months, while also warning banks against facilitating oil trade between Iran and Chinese refiners. Those actions, combined with broader disruptions to key shipping routes, have left an estimated 900 million barrels of oil and liquefied natural gas unproduced, pushing global inventories to notably low levels. Brent has rallied for 8 straight sessions, gaining roughly 27% and trading near $115 a barrel, only a few dollars below its recent wartime peak, while West Texas Intermediate sits well above 100. If the blockade persists, some scenarios point to a return toward previous highs around $125 to $130 for Brent, although demand destruction at those levels would likely cap further gains. In the meantime, rising shipping and insurance costs through the strait are already adding to the pressure, lifting pump prices and acting as a tax on consumers that could erode discretionary spending and slow growth if sustained. On top of the immediate shock, the structure of the oil market is shifting. The United Arab Emirates' decision to leave OPEC weakens the cartel's cohesion and Saudi Arabia's leadership, reflecting deeper strategic rifts and the UAE's ambition to lift capacity from about 3.6 million barrels per day to 5 million by 2027. Once geopolitical constraints ease, the UAE could bring as much as 1.4 million additional barrels per day to market, roughly 1.5% of global supply, which would put downward pressure on medium and long-term prices even as near-term risk premia remain elevated. That duality is important for energy producers and consumers alike, and it bleeds directly into inflation expectations and rate markets. Gold, meanwhile, continues to benefit from a structural bid. Emerging market central banks are accumulating bullion as insurance against sanctions and geopolitical fragmentation, while persistent U.S. fiscal deficits around 6 to 7% of GDP and a sharp increase in defense spending are reinforcing concerns about long-term debt sustainability, bolstering the case for gold as a low-volatility reserve and portfolio diversifier. Stepping back, the cross-asset picture is defined by tension between an AI-powered earnings engine and a stubborn energy and policy shock. Equities are leaning on a narrow set of megacap winners, just as the Fed signals a longer period of restrictive policy and oil trades near wartime highs, while bonds offer carry but less protection, and credit provides attractive short-duration yields alongside growing sector dispersion. A firm dollar coexists with resilient emerging markets and a steady shift of reserves toward gold, and the combination of an Iran blockade, an OPEC fracture, and persistent fiscal deficits keeps commodities central to both inflation and growth scenarios. For allocators, the critical watch points now are megacap tech earnings and AI monetization. Any change in Fed communication as leadership evolves, the depth of credit stress in energy-sensitive sectors, and concrete signs on the duration of the oil blockade. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.